Carol has not filed a single insurance claim in 11 years. Not one. No accidents. No fender benders. No late-night calls to a claims hotline. She drives carefully, parks carefully, and has spent over a decade being exactly the kind of driver every insurance company claims to want. Her record is clean in a way that most drivers would consider genuinely impressive. Her auto insurance premium this year is $2,340. That is $340 more than it was last year. And $600 more than it was 3 years ago. She has not moved. She has not changed vehicles. She has not added a driver to her policy. She has done nothing, literally nothing, to explain why the number keeps climbing. She called her insurance company last spring. She was calm about it. She asked the question that seemed completely reasonable given the circumstances. She said, politely, that she had been a customer for 9 years, had never filed a claim, had a perfect driving record, and wanted to understand why her premium had increased again. The representative read from what was clearly a prepared explanation. Something about industry-wide trends. Increased repair costs. Elevated claims in her geographic region. Reinsurance costs. Inflation adjustments. It was professional. It was thorough. It explained almost nothing she could actually use. She thanked him and hung up. Then she renewed the policy because she didn't know what else to do. Now I want to tell you about her neighbor, Greg. Greg has a similar car, a similar driving record, and lives 4 streets away. His premium this year is $1,580. He has not had an accident either. He is not a younger driver with better rates or an older driver with a loyalty discount. He is 41 years old, same as Carol. Same general profile. $760 less per year. The difference between them is not luck. It is not a secret relationship with an insurance agent. It is a set of specific things Greg understands about how auto insurance pricing actually works, things Carol was never told and never thought to ask. Pause. Music fades in softly. This isn't about your driving record. It's about an industry that has become extraordinarily sophisticated at raising your premiums in ways you won't notice, won't question, and won't know how to challenge, while your clean record sits there doing far less for you than you've been led to believe it should. I'm going to show you the real rules of why your insurance keeps rising even when you've done nothing wrong, the specific mechanisms insurers use, the factors you've never been told affect your rate, the mistakes that are costing you hundreds of dollars every year without your awareness, and the concrete actions that separate people like Greg from people like Carol. These are the things your insurance company will not volunteer. And understanding them is the difference between being a passive customer who pays whatever arrives in the renewal notice and an informed one who knows exactly what levers exist and how to pull them. Transition to core content. Rule 1. Your insurance premium is not primarily a reflection of your driving record. It is a reflection of the statistical group your insurer has placed you in, and you have more control over that group than you realize. This is the foundational misunderstanding that costs careful drivers like Carol hundreds of dollars every year. Most people believe their premium is calculated primarily on their personal driving history. They've been told good drivers pay less. So they drive well, avoid accidents, keep their record clean, and expect their premium to reflect that. And it does, partially. Your individual record is a factor. But it is one factor among many, and in some rating systems, it is not even the dominant one. Insurance is fundamentally a pooling mechanism. Your insurer is not just assessing you. It is assessing the statistical group it has placed you in, your zip code, your age bracket, your vehicle category, your credit tier, your occupation in some states, your marital status, and a growing number of additional variables that have nothing to do with how carefully you drove to work this morning. If the statistical group you've been assigned to has elevated claims because your zip code had more accidents this year, or because your vehicle model is statistically expensive to repair, or because your credit score shifted, your premium can rise significantly with no change whatsoever in your personal behavior. Here's the real-world consequence. Carol lives in a zip code where claims frequency has increased over the past 3 years, partially because of road construction creating new accident patterns and partially because of several high-value claims from other policyholders in her area. She has contributed nothing to these statistics. She is paying for them anyway. Her premium is rising because of other people's accidents in her geographic vicinity, and her insurance company is not required to explain this to her in terms she can easily verify or challenge. Rule 2. Auto insurance companies use credit scores to set premiums in most states, and most customers have no idea this is happening. This is the rule that produces the most shock when people hear it for the first time. And the shock is completely justified. In 47 of 50 states, auto insurance companies are legally permitted to use your credit score, or an insurance-specific variant of it called a credit-based insurance score, as a factor in determining your premium. The justification, from the industry's perspective, is that statistical correlation exists between credit profiles and claims frequency. Whether that correlation is causal or simply reflective of broader socioeconomic factors is a debate that has not been resolved to everyone's satisfaction. What is not a debate is the practical impact. Studies have found that moving from a good credit tier to a poor credit tier can increase auto insurance premiums by 50 to 100%. In some cases, more than a DUI conviction would raise them. The person with a spotless driving record and damaged credit can pay significantly more than the person with a mediocre driving record and excellent credit. But here's what most people miss. Your credit score can change without any dramatic financial event. A missed payment you didn't notice. A credit card balance that crept higher during a difficult month. A hard inquiry from a loan application. Any of these can shift your credit-based insurance score in ways that increase your premium at the next renewal, and your insurer will not send you a letter explaining that your premium went up because your credit score moved. The practical response is to know your credit score before every renewal and to know whether your state permits credit-based insurance pricing. If your score has improved since your last renewal, call your insurer and ask whether your current rate reflects your current credit profile. Many won't update it automatically. You have to ask. Rule 3. The loyalty penalty is real, documented, and costing long-term customers significantly more than new customers for identical coverage. This is the one that should genuinely bother you. Insurance companies spend enormous amounts on advertising designed to make you feel that loyalty is rewarded. Certain insurers have built their entire brand identity around the idea that staying with them is financially wise. And there is a surface-level truth to this. Some companies offer small loyalty discounts, modest reductions for multi-year customers. But underneath those loyalty discounts is a practice that academic researchers and state insurance regulators have documented consistently. Long-term customers, on average, pay more for the same coverage than new customers at the same insurer. The loyalty discount doesn't offset the premium inertia, the gradual, incremental increases that accumulate over years because loyal customers are statistically less likely to shop around. The industry term for this is price optimization. Insurers model the price elasticity of their customer segments, essentially, how much they can raise your premium before you leave, and they price accordingly. Customers who have renewed without shopping around for 3 or more years are identified, through their own behavioral data, as less price-sensitive. And less price-sensitive customers pay more. Carol has been with the same insurer for 9 years. She has renewed without shopping around for at least 6 of those years. She is, from her insurer's modeling perspective, a low-elasticity customer. She is paying the price that her behavioral history suggested she would pay without leaving. And she has, in fact, not left. Greg shops his insurance every 2 years without exception. He has switched insurers twice in the past 6 years. Each time he switched, he received new customer pricing that was meaningfully lower than his renewal quote from the previous insurer. The shopping process takes him about 90 minutes. It has saved him, cumulatively, over $2,000. Rule 4. Your deductible is one of the most powerful levers available to you, and most people set it once and never touch it again. When you first set up an auto insurance policy, someone, an agent, an online interface, a default setting, established your deductible. For most people, that deductible has not been reviewed since. And for most people, it is set lower than it needs to be, which means they are paying higher premiums every year to maintain coverage for losses they could comfortably absorb themselves. The deductible is the amount you pay out of pocket before insurance covers the rest. A $500 deductible means you cover the first $500 of any claim. Your insurer covers everything above that. A $1,000 deductible means you cover the first $1,000. The difference in annual premium between these two options, depending on your insurer and location, is typically $150 to $300 per year. Here's the math that makes this concrete. If you raise your deductible from $500 to $1,000, you save approximately $200 per year in premium. You have taken on an additional $500 in potential out-of-pocket exposure. The break-even point, the point at which the premium savings have paid for the additional exposure, is 2.5 years. If you go more than 2.5 years without a claim, you come out ahead. If you have an emergency fund that can cover $1,000 without financial distress, the higher deductible is almost always the financially correct choice. The psychological insight is that people set low deductibles because the higher deductible feels risky. What if something happens? But the correct question is not what if something happens, but rather how often do things happen, and what do I pay in the meantime? The premium is a guaranteed annual cost. The deductible is a contingent cost. Trading a guaranteed annual expense for a contingent one at the right ratio is the definition of financially sound risk management. Rule 5. The coverage you're carrying on an older vehicle may be costing you significantly more than the vehicle is actually worth. This rule produces some of the fastest and most tangible savings available in personal insurance management, and it is one of the most consistently overlooked. Comprehensive and collision coverage on a vehicle payout based on the vehicle's actual cash value at the time of the claim, minus your deductible. If your car is worth $4,000 and your deductible is $1,000, the maximum you can receive from a total loss claim is $3,000. That is the ceiling. The coverage cannot pay more than the vehicle is worth. Now consider what you might be paying annually for that coverage. Comprehensive and collision together on an older vehicle might cost $800 to $1,200 per year, depending on your location and insurer. If your vehicle is worth $4,000, you are paying $800 to $1,200 per year to protect a maximum potential claim of $3,000. The break-even math, how many years of premium payments equal the maximum possible payout, suggests you'd need to collect nearly 3 years of claims just to recover what you've paid in premiums. The general guideline used by auto finance professionals is to consider dropping comprehensive and collision coverage when the annual premium for those coverages exceeds 10% of the vehicle's actual cash value. Below that threshold, the coverage is mathematically questionable. Above it, you are almost certainly overpaying relative to the protection you're receiving. It gets worse. The vehicle's actual cash value declines every year. If you set your coverage based on the vehicle's value 3 years ago and haven't revisited it, the math has almost certainly moved against you further than you realize. Rule 6. Shopping for insurance produces a hard inquiry on your credit in some cases, but comparison shopping within a short window is treated differently than you might expect, and fear of credit impact is keeping people from saving hundreds of dollars. This is a misconception that insurers have no particular incentive to correct, and it costs passive customers real money every year. Many people avoid shopping their insurance aggressively because they believe that requesting multiple quotes will damage their credit score the way multiple loan applications do. This concern is largely misplaced for insurance-specific inquiries. In most cases, insurance quote inquiries are soft inquiries. They check your credit without leaving a mark that other creditors can see and without affecting your score. Even in cases where a harder inquiry is generated, the credit scoring models used by the major bureaus are specifically designed to treat multiple inquiries for the same type of coverage within a short window as a single inquiry. You are not penalized for being a careful consumer who compares options. The system is explicitly built to accommodate comparison shopping. The hidden consequence of this misconception is that millions of people renew their policies year after year without ever comparing alternatives, paying the loyalty premium we discussed earlier because they believe the act of shopping itself is costly. It isn't. The cost is 90 minutes and a willingness to talk to more than one company. The savings potential is several $100s per year, compounding indefinitely. Rule 7. Bundling discounts are real, but they are not always the best financial outcome, and most people never check whether unbundling would save them money. The bundling pitch, insure your home and auto together and receive a discount on both, is one of the most consistent marketing messages in the insurance industry. And the discount is real. Bundling typically saves between 5 and 25% on each policy. But here's what most people miss. The bundled discount is applied to prices that have not necessarily been set competitively. An insurer that knows you are unlikely to unbundle, because doing so feels complicated and you'd lose the discount on both policies simultaneously, has less pricing pressure on each individual policy. The discount is applied to a price that may already be higher than the market rate. The only way to know whether your bundle is genuinely saving you money is to get separate quotes for each policy from specialists. A dedicated home insurer and a dedicated auto insurer, each competing for your individual policy, may together offer total pricing that beats your bundled premium even without the discount. This calculation takes more effort than comparing a single policy. It requires quotes for two separate products from multiple providers simultaneously. Most people don't do it because it feels complex. That complexity is worth somewhere between $200 and $600 per year to the insurers counting on you not to run the numbers. Rule 8. The vehicles you choose to drive have dramatically different insurance cost profiles, and most people don't check the insurance cost before they buy. Every vehicle model has an actuarial history. Insurers know, from years of claims data, which vehicles are involved in more accidents, which ones cost more to repair when damaged, which ones are stolen more frequently, and which ones produce more severe injuries in collisions. All of that data is baked into the base rate for insuring that specific vehicle. The difference in insurance cost between two vehicles at the same purchase price can be substantial. A midsize sedan with a strong safety record and widely available, inexpensive replacement parts might cost $900 per year to insure. A sports car with a high-performance engine, expensive imported parts, and a statistical profile of higher-speed accidents might cost $2,100 per year to insure at the same coverage level. That $1,200 annual difference over 5 years of ownership is $6,000. On top of the purchase price, on top of the financing, on top of maintenance and fuel. It is a real cost of ownership that most buyers never factor into their purchasing decision because they check the sticker price, the monthly payment, and sometimes the fuel economy, and they stop there. The practical action is simple. Before finalizing any vehicle purchase, call your insurer with the VIN or at minimum the year, make, model, and trim level of the vehicle you're considering and ask for a premium estimate. The call takes 5 minutes. The information it produces is financially significant. Most people never make it. Rule 9. Annual payment versus monthly payment is a small decision with a consistent and overlooked financial consequence. Insurance companies charge more when you pay monthly. Not a lot more per transaction, but more consistently every year, in a way that adds up to a meaningful annual cost for something that produces no additional coverage or benefit. The monthly payment surcharge, sometimes called an installment fee, sometimes embedded invisibly in the monthly rate, typically adds between 5 and 15% to the annual cost of the policy compared to paying the full premium upfront. On a $2,000 annual premium, that surcharge might run $100 to $300 per year. This is not a fee for a service. There is no additional value received in exchange for paying monthly. It is simply a charge for the payment flexibility. Customers who pay annually receive the same coverage for less money, structurally, because they are providing the insurer with the full premium at the beginning of the coverage period. The practical constraint is real. Not everyone has $2,000 available to pay annually. But for people who do have the liquidity, paying the annual premium in full is a guaranteed, risk-free return of 5 to 15% on that amount. That return is better than most savings accounts and requires zero investment risk. It simply requires paying attention to a billing option that insurers don't particularly advertise. Rule 10. Most people file small claims they should have paid out of pocket, and those small claims are some of the most expensive financial decisions they make. This is the rule that creates the most counterintuitive advice in personal insurance management. But the math behind it is unambiguous. When you file a claim, even a small one, even one that is entirely your legal right to file, even one your insurer processes without argument, you create a claims history record that affects your premium at renewal. The surcharge applied after a claim varies by insurer and by claim type, but a single at-fault claim can increase your annual premium by 20 to 40% for 3 to 5 years. On a $1,800 annual premium, a 25% surcharge is $450 per year. Over 3 years, that surcharge costs you $1,350. If the original claim was for $800 in damage, you filed a claim that paid you $800 and cost you $1,350 in additional premiums for a net financial loss of $550. You would have been better off paying the $800 out of pocket, absorbing the cost as a self-insured expense, and preserving your claims-free discount and rate tier. But here's what most people miss. The calculation changes based on the size of the claim. A $10,000 claim is almost certainly worth filing. A $700 claim, depending on your premium, your deductible, and the surcharge structure, is frequently not. The break-even point for filing versus self-paying is a calculation your insurer will not help you make, because one outcome benefits them and one benefits you, and they are not the same outcome. The general guidance is this. For any claim where the payout after deductible would be less than approximately $2,000, run the math against your expected surcharge before deciding whether to file. The decision is not always obvious, but it is always worth making consciously rather than reflexively. Transition to closing. Carol renewed her policy again this year. Not because she researched her options and concluded it was the best available choice. Because the renewal notice arrived, the process of not renewing felt complicated, and the increase, $340 more than last year, felt frustrating, but not outrageous enough to motivate action. She paid it. She filed it. She moved on. Greg spent 90 minutes in February comparing quotes from 4 insurers. He found a policy with equivalent coverage for $380 less than his current renewal offer. He switched. He set a calendar reminder for 23 months from now to do it again. He is not a financial expert. He does not have a background in insurance. He simply knows that premiums are not fixed facts delivered from an impartial source. They are opening positions in a market where comparison, timing, and specific financial decisions produce meaningfully different outcomes for people with identical risk profiles. The $760 difference between Carol's premium and Greg's premium is not explained by their driving records. It is not explained by their vehicles or their coverage levels or their claims histories. It is explained entirely by the information they have and the actions that information produces. Carol is a perfect customer from her insurer's perspective. She is loyal, she doesn't shop around, she files claims without calculating the surcharge impact, she has never raised her deductible, she pays monthly, and she accepts premium increases with a phone call that produces no change in her behavior. She is, from the insurer's actuarial perspective, exactly the kind of customer a pricing model is designed to identify and retain at maximum margin. Greg is a worse customer for any single insurer. He compares. He negotiates. He optimizes his deductible. He calculates before filing. He pays annually. He is, from the insurer's perspective, a customer worth retaining only at a competitive price. And so he receives one. The insurance industry is not your adversary. It provides a genuinely important service, and the pricing, broadly speaking, reflects real costs and real risks. But it is also a business operating in your financial life with sophisticated tools and significant informational advantages, in a category where most customers are passive by default. Passive customers pay Carol's rate. Informed customers pay Greg's. Here's what I want you to take from this video. Your premium is not a verdict on your driving. It is a price. And prices, in markets where comparison and negotiation are available, respond to informed customers who know their options and are willing to act on them. You have never crashed. You deserve a rate that reflects that. Go find one. UTRO clean, measured, no rush. End card. If this video explained something your insurer never bothered to tell you, share it with one person who just accepted their renewal without questioning it. And if you want the exact checklist Greg uses every 2 years when he shops his insurance, the questions to ask, the numbers to compare, and the mistakes to avoid, that video is next.